Hi, this is Steve from Morager Financial Solutions. Thanks for stopping by. Really happy that you did. This is a series on pricing, and it'll certainly be educational, helpful for both consumers and also for business owners. We've already started our series on pricing signals, consumer perception of prices, how it feels, how they hear them, and also the 9 ways that they perceive them and their sensitivity models. And today we're going to talk about pricing objectives. And this is more big picture. This is where companies are in their marketplace, theories on how prices are set in general. And the first one really is that prices, we've been told since middle school that prices are based on profit, on supply and demand. Profit and loss, of course. But really one of the key parts of that is that, if that were the case, is that everybody has perfect knowledge and that there aren't more complex reasons for pricing, for businesses to set pricing. And so we know that that's not the case. What we have is really, we have businesses that they want to corner the market. That's one of the reasons why they might set the price differently than optimal for, let's say, long-term profits. They also might want to sacrifice or be willing to sacrifice long-term profits for short-term profitability. Perhaps they need to make numbers for their investors. So it's not always about supply and demand. These objectives can be quite complex. One of the first ones really is when a company is in survival mode, and they're going to price very differently than if they're in a place of abundance. So they're going to try to do everything they can to perhaps even risk long-term profitability for short-term profitability. So they will do whatever they can to move product, to get as many pieces out the door as possible so that they can survive. They are going to be flexible with the pricing, whether that's coupons, that type of thing, and they're going to adapt to what's happening in the marketplace. If somebody else, another company, decides to offer a lower price, they might even dive further down and lower their margins even more. At some point, there will be a place where they can't do that, where they will simply be losing money, and then their survival is truly at risk. So the next one is profit pricing. And this is what most of us expect, how most of us expect prices will be created. One of the interesting things, so this is where a loss leader can come to pass, where a company may have multiple products, and they're going to sell one of the products at a much lower price. And so what that's going to do is, and they're going to advertise, market, make sure the word gets out that the price is really low. And then what they do is, and this is typically for bricks and mortar, but it can also certainly be for online, where they go to get this product and there's a big sign about some other product that the company is offering. And that's where the big profits are made. So that's the loss leader is a time-tested, very successful way of bringing in new clients. Lose money on one product, make money on another product. So in this scenario, there really typically has to be a trade-off between high volume, low margin, or low volume, high margin. So commodities would be the first one, where grains, millions of tons of grains are sold every day probably. But with something, a luxury item such as a diamond ring, one is going to assume that there's going to be low sales but high margins, and there would be no reason to assume that there would be a run on engagement rings. Well, of course, there are times when that might happen, such as Valentine's Day, but typically that wouldn't happen. So there's that that piece as far as the profit pricing as well. And also with profit pricing, one of the ways to increase profits is to have the confidence that a huge number of items of a certain one of your products is going to sell a lot. So when manufacturing is set up, there's usually sunk costs of some type, whether that's perhaps, let's say, silk screening t-shirts. The silk screening equipment has to be set up, everything has to be set up, and then the number of t-shirts you would run through that is simply the cost of the t-shirt, the cost of the ink, and of course the cost of the individual doing that. But you could do, now I've never done silk screening, but you could do one, or you could have a run of 1,000. And so if you do one, the cost of that one t-shirt is going to be the cost of the setup plus the cost, those variable costs that I mentioned. If you do 1,000, it's going to be, the cost of each t-shirt is going to be those variable costs plus 1,000th of the setup cost, and then whatever profit one would want to make. So these are some of the pricing objectives, and we're going to go over a couple of the last two tomorrow. I hope that you found this helpful. I love pricing. It's so, the complexity is really interesting, and it's also, part of it is really that the people are so complex and the motivations are so complex, and I love that. So if you have a business and you would like to talk for half an hour, whatever time it might be, give us a call, give us an email, whatever it might be. We'd love to talk with you. Thanks for stopping by, and have a great rest of the day. Cheers.